So here we are in our last objective for chapter 1. We're going to look at the financial statements of a manufacturer and compare those to the financial statements we've seen for service providers and merchandisers. So first starts with the income statement. We learned back in chapter 5 of financial accounting what's called the multi-step income statement. Remember, the multi-step income statement is revenue minus cost of goods sold, which gives us gross profit. Then we subtracted out our operating expenses. That gives us income from operations. We might have had those other income and gains, other expenses and losses, and then that gives us income before taxes. We subtract out our income tax, and that gives us net income. If we look at this same financial statement, we'll notice, and if you took my financial accounting class, I tried to point this out because I knew it was coming. Notice that we don't explicitly have our costs separated by product and period, but we really do. So all of our product costs, those direct materials, those direct labor, that overhead, all of those ultimately wind up in cost of goods sold. So this cost of goods sold number right here is a product cost. That cost of goods sold number is a product cost. So all of that direct materials, direct labor, and manufacturing overhead are going to wind up here on the income statement when the product sells. Now, if you remember in financial accounting, when we said revenue minus cost of goods sold gives us gross profit, then we subtracted out our operating expenses. And I mentioned then we'll often call those selling and administrative expenses. That's because all of these selling and administrative expenses, these are our period cost. So all of our period costs wind up right there, as well as the interest expense and the income tax expense. Now here's something I want to point out to you though. As we look at our period expenses, we see that for Smart Touch Learning, depreciation was $6,000, but that's not entirely true. Depreciation expense wasn't just $6,000. That's just the depreciation on the corporate offices and the delivery truck and the sales equipment. That's not the depreciation on anything that happened in the factory. So the factory depreciation, the factory equipment depreciation, that's all up here as part of cost of goods sold because that's part of overhead. So it shows up in cost of goods sold. When we see wages are $120,000, again, not entirely correct. That's just the wages on the administration and sales staff. That's not any wages to pay to anybody that works in the factory. All the factory wages, whether they're direct or indirect, those all wound up here in cost of goods sold. This rent is not rent on the factory. This is rent on the sales store. This is rent on the corporate offices, but rent on the factory, that's up here. This is not all the insurance. This is insurance on our sales stuff. This is insurance on the corporate offices, but the insurance on the factory is up here. Okay, so when we look at these, you just need to understand that as you're looking at a manufacturer's financial statements, that some of these costs are, I'm going to use the word hidden, not because they've done anything wrong or illegal or unethical. They're doing exactly what GAAP tells them to do. It's just that some of these costs, if they happened at the factory, if they were associated with producing the product, they're hidden up here in cost of goods sold. So if we look at the balance sheet of a service company, they don't sell a good, so they don't have any inventory. A merchandiser has one inventory account called merchandise inventory, but as a manufacturer, we're going to now have 3 inventory accounts. We have those raw materials, we have that work in process, and we have finished goods inventory. Now, I like this diagram. We're going to spend the next 3 chapters really looking at how the costs flow through the accounts. And it's super important that you understand how the costs flow through the accounts. We're going to do lots of journal entries. We're going to draw lots of T accounts. I know students like to tell me that they don't like T accounts or they don't understand T accounts or T accounts are confusing. And to that, I reply, T accounts are our friends. In fact, I have pencils printed up map that I like to give students that say T accounts are our friends. T accounts are a visual representation of what's happening in the account, and most of us are visual learners to a high degree. So T accounts, if you'll use them, will really help us. But I like this diagram because it really illustrates how the costs flow through the account. So we buy raw materials. Those are both direct materials and indirect materials, and we put them in our raw materials inventory account, which is an asset. So it's on the balance sheet because it is an asset. Now, as we use those materials, we'll transfer them out of raw materials and into the appropriate account. If they're direct materials, then they will come out of raw materials and they'll go into work in process. If they are indirect materials that we're using, like the glue, then they'll come out of raw materials and they'll go first into manufacturing overhead. So then we're going to incur labor. If it's direct labor, it's going to go directly into work in process. If it's indirect labor, it's going to go into overhead. We're going to pay rent on the factory. That's going to go into overhead. We're going to record depreciation on the factory equipment. That's going to go into overhead. We're going to pay for the insurance on the factory. That's going to go into overhead. We're going to pay for supplies for the factory. That's going to go into overhead. Eventually, and we'll learn how to do this in a later chapter, we're going to take all these overhead costs and we're going to apply them to work in process. So here in work in process, we'll have our direct materials, our direct labor, and our overhead. They all come together in this giant work in process account. Now, as I finish the good, as it gets to the end of the conveyor belt, so to speak, then we move those out of work in process into finished goods. The stuff that isn't finished stays in work in process. So finished goods, think about it, this is the stuff that's moved to the showroom floor, to the sales floor. It's going to sit there in finished goods until it sells. Now, this is the part that we already know from financial accounting. So once these goods sell, we'll move them out of finished goods inventory into cost of goods sold. That's where we'll do those two journal entries where we debit cash or accounts receivable, credit sales revenue. And then we do the second entry to debit cost of goods sold, credit now finished goods inventory. The stuff that's still on our showroom floor that hasn't sold is still sitting in our finished goods inventory account, and it will appear on the balance sheet as well. Now, we've got a couple of new terms to learn. The first one is called cost of goods manufactured. So cost of goods manufactured is exactly what it sounds like. Accountants are not real creative. It is the cost of the goods that we manufactured. So if we say that during the quarter we manufactured 50,000 units, how much did those 50,000 units cost? This is what cost of goods manufactured is. So the first thing we have to do is figure out how much direct materials we used. We're going to figure out the total manufacturing cost. So this is the direct materials, the direct labor, and the overhead. And then we'll calculate our cost of goods manufactured. So to calculate direct materials used, I'm going to draw a raw materials T account down here at the bottom. Okay. So here we have our materials T account. So we have our beginning balance. Now remember, materials is an asset, so it has a normal debit balance. So we have our beginning balance is over here on the debit side of 70,000. Now we know that we purchased some materials, and we're told that we purchased $350,000 of materials. When we buy materials, we'll debit raw materials, we'll credit cash or accounts payable depending on how we paid for it. So I'm going to debit raw materials for the materials that we purchased. That gives us a total called materials available for use. So I'm just going to go ahead and subtotal that right here. So in total, we had $420,000 of materials available for use. We used a whole bunch during the year. At the end of the year, we counted and we're like, well, we've got $65,000 of materials left. Let me erase. we've got $65,000 of materials left. If I had 420 available for use and only 65,000 left, then I must have used $355,000 of materials. This is very similar to the way that we calculated supplies used way back in Chapter 3 of Financial Accounting when we were learning those adjusting entries. So I must have used $355,000 of materials. So my direct materials used was 355. My direct labor, we're told in this example, is 169. That would have come directly off my time cards. I would know exactly which employees are hands-on employees and which ones are support. And so I've just totaled them up. So that was 169. And then I have all of my overhead. So remember, the overhead is all of the other stuff that we incur in the factory, but isn't direct materials or direct labor. So the indirect materials, the indirect labor, the depreciation on the plant and the equipment, the plant utilities, insurance, property taxes, yada yada, those add up to $83,000. So the total manufacturing cost is the direct materials plus the direct labor plus the overhead. So in total, we spent $607,000 in manufacturing cost. Now, the cost of goods sold schedule is really just an exploration of the work in process T account. So I'm going to draw the work in process T account here as well. Now, we're told that when the period began, we had $80,000 worth of goods that were in work in process already. So that's stuff that we had started working on but hadn't finished as of balance sheet date. So that was $80,000. Since work in process is an asset, this is going to be on the normal debit balance. Remember that work in process is where all of our manufacturing cost accumulate. So I debited work in process for that direct labor. I debited work in process for those direct materials, and we'll see these in the next chapter when we do all the journal entries. I'm going to debit work in process for all of that overhead. So I debited work in process for a total of $607,000. That means I had total cost in work in process of $687,000. If I get to the end of the period and I look at what's still on my conveyor belt, what I'm still working on, and I say, well, that's $27,000 worth, then that means I must have completely finished and manufactured $660,000 worth of goods. This is my cost of good manufactured amount. This is the amount that gets transferred out of work in process and is going to go into finished goods. So I'm going to have a finished goods T account over here that I'm going to debit for $660,000. That is my cost of goods manufactured. It's the amount that I completed during the period and transferred out of work in process and into finished goods. So this schedule of a cost of goods manufactured is really just a way for you as the accountant to explain to your manager who may not know how to read an accounting T account. They didn't take my accounting class, or they took it a long time ago and they don't understand T accounts, and they're like, tell me how much we made last month. And instead of handing them the T account, you're going to prepare this schedule. So it shows the beginning balance and work in process. It shows how we got to the direct materials. It shows how we got the direct labor. And then it shows how we got to cost of goods manufactured. Now, once I've got cost of goods manufactured done, I'm going to calculate cost of goods sold. Cost of goods sold is really an exploration of the finished goods T account. So I'm going to draw my finished goods T account up here. So we're told that finished goods had a beginning balance of 0. I didn't have anything on my shelf ready to sell. But I know that I finished $660,000 worth of goods and put them on my shelf to sell. So I debited finished goods for that. I know that at the end of the period, I go count my inventory and I'm like, well, there's only $60,000 worth of goods left. So that means I must have sold $600,000 worth of goods. So this is how we calculate our cost of goods sold. So again, direct materials is going to flow. If you look at your raw materials, it's going to flow from direct materials to work in process, ultimately to finished goods, and then when finished goods sells, it'll ultimately flow in to cost of goods sold. So then I can calculate the unit product cost. So remember, cost of goods manufactured was $660,000, and we're told that we made 2,200 tablets. So that means we must have spent $300 a tablet. If I sold 2,000 tablets, then cost of goods sold is the 600,000, the 2,000 tablets times the 300 that they cost me to make. Remember, cost of goods sold is recorded at what it cost me, and the sales price is recorded at what I'm selling it for, which is going to be for much more than $300.